Texas Lutheran University.
Everybody take their seat. We'll go ahead and get started. I know it's Friday afternoon, and everybody has plenty of things to do on Friday afternoon that is not only beautiful outside, but it's homecoming weekend. And hopefully after Saturday, the Bulldogs will be, what, 6-0? Definitely best record we've had in a long, long time, and so it's an exciting time to be here on campus. Along with the festivities, Bulldog Investment Company, which meets usually this time every Friday afternoon, we bring in exceptional money managers and business operators once a semester. And today we're very privileged to have Zeke Ashton. And Zeke lives up in Dallas, came down just to visit with you. Not one other reason other than to come to TLU and share his thoughts. A little bit about Zeke. He went to school up in Dallas and had a very similar experience to y'all. He went to Austin College, which is in Sherman, outside of Dallas. So a school of about 1,100. And he and I have already visited about the many similarities between TLU, the fact that you've got a nice small campus, and you have professors like Melanie Thompson that call you up and say, why weren't you in class? I don't care what your excuse is, get in class. So I think Zeke very much appreciates the fact that at TLU there's not too many places to hide, but that you also end up with a really fantastic education. After school, Zeke graduated with degrees in economics and German and found himself working in Europe for almost 6 years. And that really became the foundation of his investment career, even though I don't think he even realized it at the time. He was working in risk management. So risk management, obviously, the goal is to figure out what can go wrong and make sure that it doesn't. And really, when you think about well-performed investing, and especially value investing, that's what you're really trying to figure out. What can go wrong? What is this thing valued at? How many things can deteriorate the value, and what catalyst can make the value go up? So even though Zeke may not have realized that the world of investment management was waiting for him, he was very much developing that foundation from very early on in his career. After 6 years in Europe, he came back and started writing for the Motley Fool. And Zeke does not strike me as a cocky person, but he wrote to the Motley Fool and he said, I want to work for you guys. You just tell me how much you're willing to pay. Whatever you put in, that's what I'll work for. You know, to me, that is the kind of person who's pretty confident that they're willing to allow their work skills, their work effort, really speak for itself. Now, since then, he has moved back to Dallas and runs the Centaur Total Return Fund, which is an open-ended mutual fund, and also has his own hedge fund or a private partnership. Zeke has had fantastic returns, and especially in the downturn of the market, when 2008, 2009 just crushed everybody, Zeke's firm really showed the intelligence and the wisdom behind his investing strategies as his performance trounced everyone else. So that said, let me turn it over to Zeke. He's a great guy. I hope you'll ask a lot of questions. He says nothing is off the table, so ask him the hard ones. Mr. Zeke Ashton.
Well, thanks very much. That was a little bit of overpraise there, probably. Makes it sound like I did a whole lot more than I did. But really appreciate the opportunity to come down and talk to you guys. And I am blown away that there's like 50 people in this room, because Friday afternoon, homecoming weekend, are you kidding me? Nobody comes to stuff like this. So some of you have been bribed, I'm sure of it. And if you have been, I hope it wasn't cheap. I hope you're a good capitalist and charged market value, which after you hear me talk is quite a bit. So anyway, Dave's already given you a little bit about my background. I do want to say a couple things that I think are kind of important in the career context. Most of you are probably not going to end up in a career in investment management, and you should be thankful for that. It's not for everybody. But all of you probably need a career. And so I think one of the things that was interesting for me is I went to a small school, and I did not appreciate at the time the advantage that it gave me, in the sense that Austin College was a place where you were conditioned to learn, you were conditioned to write, you were conditioned to think critically, and those are all obviously important skills. But Basically, in my first career in risk management, I got hired as an intern. I was at the University of Vienna in Austria and just talked my way into an internship there. It ended up being the first 6 years of my career just by pure luck and happenstance. But the other thing is, I got thrown into the deep end about 3 times in my career. As just an example, I have a degree in German, and I spoke pretty good German when I got hired. But I sold myself a little bit as having my German be better than it was, and before I knew it, I was responsible for our biggest German client in Munich called Siemens, which is kind of the German General Electric, right? And they told Siemens that not only was I an expert in the financial markets and risk management, but that I spoke fluent German, and their traders were just welcome to ask me all the questions they wanted. So, you know, it was, I kind of hit the ground running, so to speak. But in any case, you know, I did, I know that my presentation is probably going to be a little too basic, particularly for those of you who are dressed nicely. And the reason is that you probably don't realize what a great advantage you have, but at Austin College when I was there, we didn't have a program like this, and it would have, I'm sure, really enhanced my education if we had. We do have one now, and it's a very difficult thing for us to do. I'm too selfish to show up every week and do stuff. I go up about once a semester, and what I can tell you is that it's a great program, and you're very lucky to have somebody who will devote their free time, which is really a myth. There is no free time once you get out of here. So you should be very appreciative of what you've got, even though probably, you know, you don't like the fact that he makes you dress up on a 90-degree day on a Friday. So, by the way, I was going to wear jeans and a T-shirt. He told me you guys had to dress up, so I dressed up. So, anyway, I do want to come at this investing thing at a slightly different angle, and I'm going to give you a version of a presentation that you've probably already heard, but if you haven't, you absolutely have to hear it. I heard it when I was 17, and it's one of the things that kind of changed my life for the good. This is generally what I was thinking, and probably most of you are thinking here, is that I've got a whole lifetime ahead of me to worry about making money and saving money. I don't have to worry about it today because I'm 20 years old, right? You guys probably aren't going to retire until 2060. Think about how far away that is, right? Surely it can all wait until then, right? But to tell you why that's not the case, I want you to think about somebody who's got to retire today, right? And this isn't true in Seguin, Texas, but it's pretty true every place else. If you live in a big city anywhere in the U.S., you probably need $75,000 a year to live on. And that's probably if you've got your house paid off, okay? So how much money do you need to generate $75,000 a year if you're not working? You need about $1 million if you can do a 7.5% return, which, by the way, is not available in the bond market. So you have to take some risk to get it. If you get a 3.75, which is kind of a blend between historical equity and today's bond prices, you got to have $2 million to generate that kind of number in today's dollars, and that's after tax, okay? So think about this. If you want to retire today and you want to do it safely, you got to have your house paid for and $2 million, okay? Now, obviously, a lot of people have Social Security, all this stuff. I would encourage you to plan on not having that when you get there, right? Not because I don't necessarily think something terrible is going to happen, but I will tell you that you know, it's best not to count on that, right? So every one of you has a little chart that was on your chair, and I want you to just gaze at it for about 2 seconds. And the reason I want you to gaze at it is that it's what the value of money looks like. Yeah, can you hold that up, Dave? So basically the chart says this. $1 of purchasing power in 1914, which is exactly 100 years ago, is worth about 5 cents today, okay? Now, that's important for you because in 2060, basically your dollars, if you just put them under the mattress today, are probably going to be worth about 35, 40% of what they are now, right? Somewhere around there. So $2 million is not going to cut it for you, which means you need more, okay? How many of you were planning on coming in here today and having some guy drive down from Dallas and tell you you need $5 million by the time you're 65? That's what you need, okay? Sounds crazy, doesn't it? Am I crazy? I look crazy. I'm not crazy. You need $5 million when you're 65, okay? And I'm hoping that's a number that's safe. So I'm overshooting a little bit for shock value, okay? But if you don't see yourself as having $5 million, then I want to wake you up a little bit, okay? Because that's what you're going to need. So we talked about the value that you're going to lose with inflation, so you've got to be cranking out. But this is interesting. If you're 65 today, you're probably going to live to 90, statistically, right? Which means the value of your dollars that you're no longer earning because you're not at a job are going to drop maybe by another 25, 30% by the time you get to 90. And hopefully you'll live that long. And you guys will probably get to 100 because medical technology is starting to replace bad parts, right? It's really good now what they've got. In 1995, I gave myself the gift of getting eye surgery, okay? It's something called radial keratotomy. Nobody does it anymore because it's barbaric, okay? I'm not kidding. It was a scalpel and 2 Valium. Right here, okay? Okay? Yeah, and I loved it. Loved it. It worked. I mean, went in, got the scalpel, got 2 Valium, you know? But I saw it coming, let me tell you. So, $5 million, that's the number, okay? So, our culture today is very weird about money. Everything you see on TV, what you see with your friends probably, it encourages you to consume. The smartest people on this planet are employed at companies who are designed to separate you from your money and ideally to have recurring revenue, to make you pay 19 bucks a month, right? Small number every month. But if you add that number up over a long period of time, it's a lot of money. So what you don't have in this culture with a lot of people telling you is how to save, okay? Because nobody does it in America. In places like China, they save like 25% of their income. That's average, okay? Because they don't have a lot of the safety nets that we're used to, right? And they don't have quite, they're getting the culture. We're shipping them our consumption culture, right? But right now, they still have the history of, that teaches them to save. So the second thing is, so you got to save, and then if you are interested in investing, even some basic understanding of investing principles will vastly improve the financial life that you're likely to have. Just some basic understanding. Now, you can go deeper than that, right? And some people can go really deep. But what I would say is that if you just have a few nuts and bolts, it will dramatically change your financial life. And what I'll tell you is this. My parents aren't people that really believe in money per se. They sort of don't trust it. And I like to explain to my parents what it is. It's freedom, okay? If you have some money, you are free to take advantage of things. You're free to give to noble causes. Yes, you're free to spend on yourself and others, but it gives you optionality in life, right? And it also gives you freedom from worry. A lot of people have financial difficulties in our culture, and it creates a huge amount of stress, huge amounts of worry. Lots of divorce is caused by money issues, okay? So again, this is very basic stuff, and I'm sorry I'm not doing the whole discounted cash flow analysis sort of stuff for you here, but I just want to make sure if I talk to somebody in college, man, this is what I wanted to hear this. I heard a version of it, but not as strong as I'm giving to you today. Because I know some of you are, getting ready for tonight, whatever. I just want to wake you up, okay? So, this is the good news. People with average IQ, but a really good disciplined plan, do way better than people with really good IQs. So Mensa. I didn't even apply to Mensa, right? My IQ is probably 50 points too low to get in. But between 1986 and 2001, Mensa generated 2.5% annualized returns on their investment, while the rest of the stock market did 15. Okay? Now, I'm not always, benchmarking is not always the greatest thing in the world, but what this shows you is a high IQ is not necessarily a ticket to better results. Okay? So, just to quickly wrap up this little section, you do need some brain power, but you don't need to. None of you guys actually need to pick your own stocks. You just need to have a plan that makes sense and stick with it, whatever it is. And I encourage you to be thinking about this. And when you meet Mr. or Mrs. Right, got to have the plan with that person, okay? Because couples that don't see eye to eye on how to handle money run into trouble. And so it's a good thing. It's a good litmus test for you, okay? And by the way, I think Warren Buffett is a very wise man, and what he said is that once you make the decision on who you're going to marry, that decision will cause 90% of your future happiness or misery, right? And based on my life experience, and I know I look a lot older than you, but I'm 20 years out of school. It doesn't seem that long, but I've seen a lot of my friends go through a lot of misery with that whole thing. So I can tell you it is for real. So brain power, a little bit. Time, a whole lot. And what you have on your side right now that I don't have, and Dave really doesn't have, is a lot of time. Sorry, Dave. So, by the way, does he not look like a combination of Warren Buffett and the drill sergeant? Like, he totally looks like he'd make you drop down and do 20 push-ups if you just messed up a number or something. So, anyway, this shows just how simple this can be. Now that I've scared you with how big a number $5 million sounds like, right? Look, this is just the math. This is why it's not crazy. Okay, now it obviously depends on the return you get, which you have a lot less control over than you think. But if you can make yourself save $6,000 a year and you get a 5% return over 45 years, you're already at $1 million. Now $6,000 sounds like a lot. It's like $500 a month, and it's after, you got to save that after tax. But still, it's not crazy numbers, right? It doesn't seem like that should get you to $1 million, but it does. And if you can just, with a little bit of better results than the average, maybe, at 8%, you're at 2.7. That's saving $6,000 a year. But you got to do it for 45, right? Okay? Now, this is the crazy thing to me because it's always been unintuitive to me. And that is this, the time. So let us say that you have a friend that decides to get a PhD, and he waits till he's age 30 to start saving and investing. And you are too lazy to get a PhD, so you get a job at age 24, but you're starting to put $2,000 a year away, right? You do it for 5 years till you're 29. And then you're like, this saving thing is stupid. I'm going to go out and buy myself a Mercedes, right? Your friend gets out of his PhD, and he starts saving $2,000 a year, but he does it all the way through age 65. Now, you guys probably know the answer because I'm setting it up for you. Who's got more money at the end? At age 65. Oops, I think I missed this. Oh, well, I'll tell you. The difference is the guy who did the PhD by 10 grand, okay? So what I'm telling you, and by the way, please don't take this as me encouraging you not to go get a PhD. If your heart is set on being a PhD, it'll make your parents very happy. What I'm telling you is this is the amazing power of starting a little early. Now, all of these charts that you'll read in the world assume that the market goes up at exactly 6% every year. That's not the way it works. It's way more complicated than this, okay? But I'm just showing you that math does get you there. Getting wealthy is a purely mathematical issue, okay? And it's about 3 things. Dang it, I keep doing that. Savings, okay? Most of you can control how much you save. And here's the amazing thing. It has nothing to do with how much you earn. It helps if you earn more, but what I've discovered is the more you earn, the more you tend to blow, right? And so here's another thing is I've made some money, and then I've had times when I've made no money. And I've been really poor, and I've felt like I've been really rich, right? I've learned since that I'm not ever going to be really rich. But I felt rich, because a lot of it depends on where you start, right? And believe me, I've been poor. But the savings, what I've discovered is it's pretty easy to give up the Starbucks a day, right? You have no idea how much of a mocha frappuccino will add up over time, right? If you spend your money that way, okay? And I'm as bad as anybody, man. If I see a Starbucks, I'm like Pavlov's dogs. I'm like, I can't help it. It's like, it's like a tractor beam that pulls me in, and I order something, I don't even know what it is. It sounds vaguely Italian. Before I know it, it's $6, right? Well, you do that every day, and it's not going to be good. Now, I will tell you this, is that some things, my view on consumption is this. It's better to have a few things of very high quality than to have a whole lot of crap, okay? That's my personal philosophy. Other people may differ. I'm not religious about it. That just seems to work for me, right? I feel that way about a lot of things, but, it doesn't really matter. As long as you determine that you're going to save some portion. And, you're young now. You're sort of used to living on, ramen noodles, right? Don't get yourself spoiled early, right? When you get out of here, if you can room with somebody, if you can do something to save, there's a lot of pressure in our society, I think particularly on young men, to have a flashy car so you can, pick up a date and feel good about it. Find a woman who doesn't care what kind of car you have. But that said, don't drive a total beater. So, okay. return plus time minus taxes, okay? You have a lot of control over the savings rate. You have some control over the return. You have a lot of control over time right now, but time gets away from you really quick. You have no control over taxes, but if you take advantage of the IRAs, if you take advantage of those things, taxes saves you for a while, okay? Although I'm even suspicious that at some point our government may do some stuff with the taxes. Like you think you have IRAs, but maybe you don't, okay? But that's the key. You got some choices as to where to invest, right? I know you guys know what the stock market is, but I think it's important that you hear it. It's just a fractional piece of a business. That's what it is. And the beautiful thing about it is you can be an owner in America of any business that's publicly traded. If you think Apple's the greatest thing ever, you can be a part owner of Apple. That's the beauty of capitalism. A lot of countries don't have that or didn't have that, okay? A bond is just a promise to repay the money that you lend with interest, okay? So you loan somebody a 10-year money for 5%. At the end, you're going to get your 5% as you go. And if they're still around in 10 years and they can pay you, you're going to get your money back, okay? This is why I don't like bonds. It's not that great. Now, sometimes you can buy a bond at 50 cents on the dollar, and then if they're around, they got to pay you the whole dollar, right? And you get some interest at double the interest. Sometimes that's interesting. So real estate, I would basically say that real estate, you can make some good money renting real estate, whatever, but you can apply the same value principles to it. You can value a piece of real estate just like you can value a stock based on the amount of cash it will kick out to you, okay? And then there comes the hard stuff. Commodities, gold, and silver. I don't know how to value those things. What I can tell you is this. That chart that I showed you about the dollar and how it turns into 5 cents after 100 years, if instead of putting it in a bank and leaving it in paper money, if you'd have just kept the Morgan silver dollars that the government used to issue that represented a dollar, that would be worth 16 bucks today. So that's almost exactly the 95% loss. You don't have that option because the government no longer gives you valuable metal that you can carry around in your pocket, right? But that was, so a lot of people will make an argument that gold and silver will keep up with inflation. But as I showed you, you're not trying to keep up with inflation. You got to beat it, okay? Collectibles, I'm agnostic about this. I'm a believer that if you have money and you like art, you should buy art for the enjoyment. A lot of people flip art. Comic books, coins, I own some old coins because I think they're historically interesting, but I don't think I'm going to make any money on them. And then there's all these other things that a lot of people in our society, particularly people that don't have a lot of money, their best hope is the lottery system, which is the worst investment scheme ever, right? And I think it's really unethical that our government pushes this on the people who can least afford it. As my dad says, it's a tax on people who are bad at math, right? So it doesn't take a lot of effort to figure out. Now, if you enjoy playing the lottery, if you enjoy going to Las Vegas, if you consider it entertainment, that's fine. Don't put it in your savings in bucket, right? Don't think you're actually have an intelligent investment approach, right? A lot of people, though, they're desperate. That's the only thing they can think of, and it's terrible, okay? Now, I've been to Vegas. I like Vegas. I don't invest at the lottery. I don't invest on the floor, right? First of all, I play probabilities for a living, so it's not really relaxing for me. But second of all, let me tell you, it's pretty depressing if you step back and look at what's happening there, okay? But again, everybody's got their own taste. Okay. It's also important, I think, to understand what is the stock market, why does it exist? Is it just for Jim Cramer to yell at and tell you what to buy and sell? What it is it promotes capital formation. That says formulation, but I'm really bad at spelling too. But basically, a lot of companies need capital to grow. And they don't want to do debt because if they go bad on their debt, somebody else owns the company. The stock market allows them to access the capital, and it allows you as a saver to be a part owner of productive businesses, right? So that you can make money while you're sleeping. That's the beautiful thing about owning investments is while you're sleeping, somebody at those companies is working and they're making you some money, right? So to me, that's one of the biggest ways to get wealthy is if you're making 150 bucks an hour, that's great. But if while you're sleeping, somebody else is making you 150 bucks an hour because you've saved and own a piece of that business, that's even better. That appeals to my lazy side. The U.S. stock market offers you about 15,000 businesses, believe it or not. Now, a lot of them are very small, and a lot of them won't tell you won't see them on CNBC. But nonetheless, they're out there, and you can be a part owner in whatever business that you admire, that you like, that you think is cheap, however you want to invest, right? What is critical, though, is it is not the job of the stock market to value a business. I hear this all the time. and then people say this business is worth X because today's quote says it is. It is the stock market's job to provide liquidity to people who want to sell and to provide the ability to purchase to people who want to buy, right? The stock market guarantees you a price. It doesn't guarantee you a fair price, and that's the difference. A value investor tries to value the businesses, and he doesn't want to pay a fair price. He wants to pay an unfair price, right? And he wants to sell it back at a fair price or maybe a little better. That's the key to value investing. And there's a guy, Ben Graham, who wrote this parable of Mr. Market, which is really good. And he says that basically the stock market's like a what's the term? I'm thinking passive aggressive, but that's not it.
He's either very happy or very depressed.
Manic depressive, that's the term. It's like having a business partner that's manic depressive, and he'll come to you one day and go, oh, I love that business. I'm willing to pay you twice what it's worth. And you go, okay, fine. And then maybe a couple months later, he's all worried about the world. He goes, oh, I hate this thing. I'll let you have it for half price. And you go, okay, I'll take that, right? But you got to know more than the market, or else you shouldn't be engaging. You should not be engaging in transactions with the market unless you think you know better, and that doesn't come often. But when it comes, you got to take advantage of it, okay? And you have to kind of know how to value the business, okay? So that's what this is. Here's another concept that I learned really at Austin College, and that is if you want to get really good at something, it doesn't matter what it is. Look at somebody who's really good at it and see if you can sort of emulate what they do. And some people are just geniuses, and there's no way you can emulate what they do, right? I think Kobe Bryant's a pretty good basketball player. It doesn't help me to watch him dunk because I can't jump, right? He can do the windmill dunk, and then I can go get my Nerf set and put it about 6 foot, and I can dunk just like Kobe, right? But I'm not going to get paid $10 million a year to do it. But what this guy does, and by the way, Warren Buffett is also, he's the Kobe Bryant or the LeBron James or whatever of investing. He's smarter than all of us. He will always be smarter. Well, that's not true because he'll be dead soon. But while he's alive, well, sorry, that sounded bad. Statistically speaking, he's 85, okay? Hopefully you'll outlive him, okay? Anyway, that really did come out poorly. I'm really sorry. And I love Warren. I'm choking up a little bit thinking about it. You're not going to be as good as Warren Buffett, but you don't have to, because you're only competing against other people, many of whom don't care at all about value, right? And he was taught by Benjamin Graham. He's also been influenced by Philip Fisher. So those of you who are real geeks about this, you might want to go take a look at what Benjamin Graham and Philip Fisher wrote. By the way, our culture seems to think that Donald Trump's a really wealthy guy, right? You look at The Apprentice, you see all this stuff. People think of rich people in the United States and think, oh, Donald Trump, you know, he's the guy. This is 2011 Forbes. This is what Warren Buffett, his net worth was, and there's Donald Trump over there, okay? Now, by the way, I'm not denigrating Donald Trump because that's still $2.3 billion, okay? And there aren't a lot of billionaires walking around, okay? And I'm certainly not one of them. But what I can tell you is the value investor guy has beaten very systematically the real estate guy. The other thing is this. Donald Trump takes on a ton of leverage to do what he does. And he has been near bankrupt about 3 times, okay? And I'm sure it's caused him a lot of worry and concern. And he's also not made that much money for other people, whereas Warren Buffett has made many, many, many other people into millionaires who have held on to his stock, Berkshire Hathaway. So that's why I admire Warren Buffett more than I admire Donald Trump. That said, I mean, Donald Trump's done okay. So I kind of want to run through this really fast because I want to get to questions, because I'm hoping that some of you guys have been woken up by this a little bit, or you just kind of want to ask me something crazy and see if I'll say something funny. But I do want to run through this. You know, again, value investing, you're trying to buy assets for less than they're worth. The reason I like it is it works everywhere. It doesn't just work in the stock market. It works in real estate. It works in just about any form of real investing that you can think of. So here's some basically comments. I'm going to let this go because you guys will have access to this later. So what is speculation? Speculation is buying something without really knowing what it's worth on the hopes that somebody else will pay you more for it, okay? It's not immoral, it's not unethical, and sometimes it works. I do a little bit of it myself because I can't help myself. I'm an idiot, right? But when I do it, I know I'm doing it, and I keep it small. That way, if it doesn't work, you know, I don't really beat myself up. I like this Mark Twain's quote. There are 2 times in a man's life, also a woman, when he should not speculate. When you can't afford it and when you can, okay? But I think most market participants are actually speculators. They don't really know what the thing is worth. They think of it as a sort of a trading vehicle, and you can take advantage of them from time to time, okay? Also, something that differentiates value investing from other forms is margin of safety. Just this emphasis on not losing money, making sure that you're not saying, hey, this business is worth 100 million, I'm going to pay 92, right? You want a bigger gap than that because valuation is imprecise. It's an art, not a science. The future is unpredictable. And if you have a margin of safety, not only in investing, but in life, right? If you think about what investing is, it's the art of making good decisions, okay? I would argue that that extends to life. Life is basically a series of small and large decisions, okay? If you teach yourself to make good decisions, you will have a good life, right? Now, that doesn't mean not every good decision has a good outcome, right? I could decide to take route A to work or route B. And unbeknownst to me, if I take route B, there's a tractor trailer waiting to kill me, right? Out of my control, and it might happen tomorrow, okay? But, you know, chances are that's not the major decisions that I'm going to look back on in life and say, oh, if I had just taken route A instead of route B. But the decisions of how to save, how to invest, who to marry, what jobs to take, that sort of stuff, you know, those are important decisions. How you spend your time on a daily basis is pretty important. People who find 30 minutes a day to exercise live a lot longer and are typically happier than people that don't, right? But you kind of, every day you kind of are confronted with that decision. So either you do it or you don't. So the golden rule of value investing is don't lose money. It's very trite. It's very unhelpful, I think, right? But what it really means is, you know, try to make sure that you look at the downside, make sure you've got some protection so that you can't lose much. Okay? Again, value in the business is the key. If you understand what a business is, it's just a combination of resources, both physical and human. There's a lot that goes into it. I'm here to tell you the people that make it seem like valuing businesses are easy, it's not easy, at least not to me. Okay? I think it's hard. It's always been hard. It's harder now than it's ever been. But what that means is you've got to limit yourself to the businesses that you really understand. And to understand something, you need to build what's called a circle of competence. And that is, let's say you're only interested in retail businesses, and you just looked at a retail business and you study that sector over and over. You will eventually get very good at it, right? And what's interesting is, I think there's probably only about 10 ways that humans have ever discovered to make money. In other words, there's 10 basic business models, or 12. There's not very many. So if you know how a retail business works, you know how a huge swath of businesses work. If you know how a software business works, if you know how the banking business works, right? If you understand how natural resources are monetized and businesses are created out of them, all that stuff, I mean, honestly, it's really hard to get a bigger list than this. So you can focus on what you're good at and just play that. It's like a guy who just plays Texas Hold'em, doesn't play all the other games. Just gets good at one, right? How to build your knowledge base. Start with where you're interested in. And what I've discovered is if you read the annual reports from like the top 5 or 10 businesses in that industry, you pretty much know what's going on in that world. I find that that's very helpful. If you find something that you don't like or you don't understand, or it just doesn't make you excited to study it, skip it and go on to something else. What I find is that if you find something that really has some sort of innate attraction to you, you know, and I tell you, one of the great things about the business is, you know, I'm curious about a lot of things. So one day I'll be studying a biotechnology company that's, you know, sparsing mouse DNA to create a vaccine. And the next day I'll be studying like a cement company in Sri Lanka or something, right? I mean, it's just a crazy, you know, you have all these choices and you can learn a lot of stuff. But over time, you will develop and you will learn what's good for you. So obviously you want to wait for an opportunity that's pretty clear. You don't just invest in anything that you see. This comes back to thinking about the market as someone that serves you and not someone that you let influence you. This is kind of important too. You'll make yourself miserable if you benchmark yourself to what everybody else is doing and what the stock market is doing. The world very much wants to pressure you. If you're a professional manager like I am, you got to live with the fact that if you think the market's overvalued but it goes up every day, you're going to get fired by some people, right? That's just the nature of the world. So you have to figure out who you are and what you believe in, and you got to stick to it and not let yourself be influenced. But as an individual, unless your wife or husband fires you, says, hey, you can't invest in stuff anymore, you're just not good at it, you can keep going as long as you have some money, right? And so I think it's really important to focus on making money and taking low risk as opposed to keeping up with some benchmark like an S&P or whatever. So if you don't know what to do, just hold on to your cash until you do, right? A poor decision is always worse than no decision. And then for those of you in the front that are actually, probably investing in stocks, these are just some sell advice tips that I have. I think selling stocks is the hardest part of it because it's really hard to know when to do it. But this is the last thing, and I think this is Warren Buffett's most classic advice. Try to be fearful when others are greedy, greedy when others are fearful. The time to buy stocks is the bottom of 2008, 2009, when it's the hardest thing in the world to do because it's going down every single day. And up until a couple weeks ago, I'd say this environment that we've been in recently is the time to sell stocks, not buy them. So anyway, I'm going to leave it there. I really appreciate you guys showing up and listening. And I didn't see anybody fall asleep. And I really appreciate that because that's happened. And you know what's really sad? One time it was me. So, but I'm going to open it up for questions. I don't know how, Dave, you want to MC this or just let them shoot or whatever. And by the way, you can ask about career stuff if you're not, if the investing thing is not what's on your mind today. Outside of things like theology, which I'm not qualified to answer questions on, but anything else, life advice, investing, whatever. Did you have a question, ma'am?
Sure. I have a question.
Okay.
So you're advising young people, obviously, say have a longer time, so they can take on more risk as the conventional thinking. But what about, okay, so they should probably study and do stocks and all of that, because they've got to cover or something else. What about things that are tax deferred, like an IRA, or supplemental retirement? Should they be starting, adding to their supplemental right away, or should they be working with purely higher risk things because they've got 5 years?
Okay. I mean, that's a very interesting question. There is this perception in the world that risk is a dial. Okay? You want high returns, you dial up the risk. You want low returns, you dial down the risk. And I think that's a very harmful perception because what it assumes is that, hey, if I just take more risk, I get more return. But if that was the case, they wouldn't call it risk. What risk is that a lot of things can happen and a lot of them are bad. Okay? What I would say is this, is that the stock market in general or individual stocks are risky at one price and not risky at another. So to say that, hey, you should put your money in risky assets because you can afford to lose the money now, you have your life, I personally don't agree with that way of thinking because it just doesn't make sense to me, right? To me, you should never invest in a risky asset unless you have really done the work to make sure that you're truly going to get an incredible payoff for taking the risk, right? And I think that a lot of people are attracted to risky assets after they've done well and when they're so fully priced that it's all risk and no potential return now. Does that make sense to you? So what I would say is this, is a lot of it depends on what you're personally comfortable with. I know people who are 24, but they're just hardwired to see methodical progress every single month, right? And if that's the case, you don't need to be in the stock market with 100% of your money, even though statistically they would say, yeah, that's where you should have all your money because you can take it if the market goes down. Well, it's not really an age thing. It's almost a wiring thing, right? Some people are just not wired to take that. And they'd much rather make 4% a year on average, start out with 20% of their money in the equity markets and 80% elsewhere, right? And just have their value of their account go up every quarter. That just feels good to them and it keeps them going. It doesn't scare them out, right? And some people are like, hey, I'm not even going to look at it. I'm just going to put it in. And, I generally think that younger people should invest more in stocks. That's the conventional wisdom. Also, I hate bonds. I just hate them. I don't understand why I'd lock my money up to somebody for 10 years for 3%, particularly if I'm not 100% sure they're going to pay me back, right? It seems to me like my upside's pretty low and my downside is potentially catastrophic. So I'm very biased towards stocks, but like right now in our funds, we've got 30% of the money in cash, which earns nothing, right? Only because I can't find enough good stuff where I'm willing to take, where I think I'm getting paid for the risk. So if you don't know anything about value and risk, you're better off just sort of setting the conventional standard of 70-30. But if you know yourself and you know you'll get upset, if you see a quarter where your account's down 10%, then you try to, maybe you'll go 50-50. So I think it's a very personal decision, but I think it's a very good question. I get it quite a bit in terms of that whole risk being a dial thing. And I hate that concept, because if that were the case, if you could just dial up the risk and get higher returns, wouldn't everybody do it? And wouldn't it be no risk? So it's one of these, I would say a catch-22. So I appreciate the question. Anybody else? Slim Shady. On the front row.
Yeah. So you mentioned the overvalued market and that currently you're holding 30% cash. When you are investing with other 70%, where in this market right now, and how are you finding uncovering value?
I'm not doing anything different than I've always done. I have kind of a process. We screen based on statistics. We obviously have a huge database of stocks we've looked at in the past and tried to value. And just because the market, in my general opinion, is pretty fully valued overall, there's still things that we think are either relatively cheap or truly cheap. There's almost always something that's really out of favor at the moment, right? And so, we just kind of look at company after company after company, but usually we come in when there's been bad news. One of my favorite things to do is look at the stocks that just got whacked 20 or 25%, right? Because probably somebody there is selling who doesn't know why they're selling. They're just selling. They're scared. They don't like it. Makes them feel bad. There's this emotional cascade that kicks in for some people. And so, unfortunately, just buying everything that just recently got sold off by 25%, sometimes that can lead to the next 25% down. So you really have to know, hey, what is it that went wrong? Is the market overreacting? But it all comes down to this: what's the business worth within a reasonable range of probability? And by the way, there are many businesses that I've been doing this for a long time that I cannot value at all. I have no idea what they're worth, right? And I just don't play in those businesses. So I wish I could give you a more sort of comprehensive answer, but that's just, I think that kind of covers it for me. Do you have a question?
Going on the theme of reacting to kind of bad news, in your portfolio you have like JP Morgan, you guys a little like Tarpson, but you stayed away from AIG in 08 and 09. You still are away from AIG. Is there a reason for that?
I did own AIG. I bought it in 2011, and I bought in-the-money calls, which were like the warrants, but actually cheaper in my view. And so I played AIG for what I thought was the safe money, which was about 36 to 50. That's one of the few things that went really kind of right for us. Honestly, though, the reason I sold AIG was one day I realized that I just didn't really deeply understand it anymore. And it's just a very big, complex business. I thought at 36 it was on the easier end, but at 50-something, the book value is 66, and book value is kind of it's not always liquidation value for an insurance company, but at least you can start there and kind of say, okay, how would I change the true value from book value? So the great thing about insurance companies is they tell you what their economic value is every quarter. They'll say, hey, our business is worth $52.60 on a book value basis, which is GAAP accounting. The problem is GAAP accounting is often quite different from true economic value, okay? So you have to make some adjustments, but that's kind of, to go further, I'd have to get all geeky on you, and I don't want to do that to the people who don't want to hear about it. So, but if you're interested, I can give you a little more detail. So, Sarah.
Earlier you mentioned, in response to Ernie's question, you said there's some companies that you stay away from because you don't know how to value.
Yeah.
What would you consider your circle of competency then?
Yeah, I've had pretty good luck with things that generate pretty consistent free cash flow, and it doesn't really matter what the business is, as long as it's something that it's really helpful if the business is not technologically have a lot of turnover, right, in their product cycle. That said, like when Apple got to $400, it was trading at something like 7 times the cash they were going to generate this year, and I kind of felt like, there's an Apple store right around the corner from our office, and every time they have a new phone, even if it looks just like the last phone, if people camp out for days, that is a brand. There are brands in the world, and everybody will tell you, oh, our brand is great. There are not a lot of brands that people are willing to line up out of the store for 2 days, right? And so 7 times free cash. Even though Apple's a very difficult business to figure out, hey, what's it going to look like in 20 years? That was so cheap that we just kind of said, hey, it's almost a no-brainer for us, right? Biotechnology stocks are pretty tough if they don't have drugs on the market, right? Because it's 50-50 sort of whether they'll get approved or not. There's a lot of businesses that are just very cyclical. In other words, when things are great, they make a lot of money. When things are bad, they lose a ton of money. I'll say gold mining and metal stocks. Mining is the worst business probably on planet Earth. I mean, it's just a terrible thing. It's hard to make money doing it. So we don't go there. But those are just some examples. But I would say that's another very personal preference. I mean, I know guys who can make, and again, I think metals and mining is the worst, hardest place in the world to make money. I know guys that can make money there reasonably consistently. I don't know how, and I can't do it. So again, it comes down to that circle of competence thing. So, but what you'll find is that you'll see patterns, right? And you'll see a pattern, and then you'll see another stock that almost looks like the same thing. You can make some comparisons, and the first one worked out well for you, and you have some confidence the second one has the same sort of setup, and you'll be able to do that. One we were talking about at lunch is what I call good business, bad business. There's a lot of businesses that are publicly traded that are actually holding companies that own a bunch of different businesses. And sometimes there's one really bad one, and there's one really good one. And the market kind of just values the whole thing on average, but you know that if they got rid of the bad business or sold it or shut it down, they'd be left with just the good business, and then all of a sudden the market value would have to double, right? Or whatever, because now you're just being valued on the good business. That's a pattern that we've looked at and has worked out well for us, and it's not industry specific. It's just one of those funny things. So, yes, ma'am.
Can I ask a different kind of question?
Please.
So, what do you think the biggest mistake that you made when it was early on, and how did you learn from it?
That's a good question and a very difficult one, because to say that I regret some of the decisions I made would sort of say, I mean, every decision I've ever made has shaped who I am now, and I'm okay with where I am. On the other hand, I wish I was smarter, taller, better looking, able to jump higher, all that stuff, right? But I also didn't really know what I wanted to do until I was 30. The investing thing didn't come to me early. It came to me late, after I had done a lot of other things. So, I was a disinterested high school student, and Dave kind of left this piece out of my bio when he introduced me. I didn't graduate from high school. How about that? My parents were shocked. So, but particularly they were both educators, right? But I went to work for Bear Stearns when I was 18, which was a big Wall Street firm, and I totally realized when I was there that I was out of my depth, right? So that might have been a mistake, except that I then went back to college, realized that I needed some skills, eventually found the place for me, which was Austin College, with a very similar setting to this one. And I can't say that everything that I've done in my life has worked out as well as I'd hoped. But I can't think of any one big thing. As long as it's not fatal, as long as it doesn't, put you on. There are some mistakes that have tragic consequences, right? That just rolls through the years, and you can't ever. I've got a friend who, he's a little older than me, and back in the day when cocaine was the big thing, he thought he'd try some. It turns out he was in one of 3 states that if you had over a small limit, you were considered a dealer, right? It was back in the say no to drugs age, right? And he was just a guy who did something stupid. He was very young, but now he's got a federal offense on his record. That is a tragic mistake. He can never recover from that. It has changed the arc of his life, okay? So to say that I've never made a terrible mistake means that I've never done anything that's dramatically changed the arc of my life that I couldn't recover from. And the truth is that if you go through your life and you don't lose a year or two because you made some mistake, or you don't know who you are anymore, or life didn't throw you a curveball that you had to try to figure out and recover from, you've not lived a real life, I don't think. And if you think that you should have that life, I'm here to tell you that's not the way life is, because it will knock you every once in a while. And it's not the stuff that you worry about. It's something that hits you on a random Tuesday, So worrying about it doesn't make a lot of difference, but I encourage you guys it's okay to make mistakes. Just try to avoid the ones that are fatal that you can't recover from. So, Warren,
So
he's going to hit me with
that
one.
Same line, you've traveled extensively, you lived overseas, these are young folks. How does that shape you? How does that influence you? Is that good? Is that bad? Kind of about that.
That's a great question. for those of you, how many of you guys actually speak a second language? Okay, that's pretty good. Actually, there's a lot of Americans. You'd be amazed at the percentage of Americans that don't have a passport. You'd be amazed at the number of Americans that don't speak a language other than English, okay? And I didn't think I was smart enough to learn a second language because I'd never had any scholastic success in my life until I went to Austin College. And they encourage/force you to take a second language because they're a liberal arts college and they take that pretty seriously. And then they give you a lot of incentives. So I took some German classes. They said, hey, you should really go overseas. I went to Vienna, where they speak some other language that they call German. But what I will tell you is that learning another language, particularly when you're an adult or, over the age of, I would say, 6 or 7, it takes a certain amount of wiring in your brain, and it changes. I think it enhances your cognitive skills. Certainly living in Europe was a great experience for me as a young person, because what I learned is I wasn't very flexible. I liked what I liked. I liked to have, the Texas-sized house and the easy parking availability, and I like to be able to walk into Walmart at 2 o'clock in the morning and, buy a bottle of Pepto-Bismol and drink it right there, right? I'm telling you, I'm a little crazy. Seriously though, you go to Germany and you're working 70 hours a week and nothing's open on Sunday, right? You go to Italy and you got a project to do, and everybody in the bank just takes the whole month of August off, and you're stuck there to try to do some stuff. It teaches you some adaptability, right? Before I was 24, I never ate a salad in my life, right? I was your typical, I had to expand my culinary horizons a little bit to live in Europe, let me tell you. Because they don't do the ketchup on the side. They don't do the, they just, you order it, they plop it down, right? You better adapt, okay? And there are people like Navy SEALs who do things that you would not believe humans are capable of doing. And what I can tell you is that to stretch yourself a little bit, to put yourself in some position of discomfort, particularly when you're young and you're not set in your ways yet, is a very valuable thing. And I would certainly recommend to any of you, before you have a family, if you have the chance to get overseas in a working capacity, or even as a volunteer for something, if you can volunteer and be overseas, I highly recommend it, particularly if you don't have daily access to people who speak English. That forces you to learn a language. If you're a guy, get a girlfriend who makes you speak that other language. That's the best, I tell you, that's the best language learning method there is. If you're a girl, get a boyfriend who doesn't speak English if you want to learn that language. Let me tell you, you'll learn it really, really fast, okay? So girls, to get what you want, guys, to defend yourselves. That's how that works. So, anything else? Yes, sir.
Having graduated from a small school, much like Lutheran, how would you say that after graduation that helped or hurt you?
What I will say is that when I was in college, I had this really strong feeling that having good grades was incredibly important. And somebody's going to be mad at me after I say this, but the truth is, once you get out and you're in the workplace, it's important to get in. Having good credentials gets you opportunities, but once you're there, people don't care what college you went to anymore. They don't care whether you had a B- or a B+ in chemistry. It's all about what you do. It's all about how you perform there. The question that you didn't ask, which I also struggled with, was should I go on and get an MBA, right? Should I spend the extra money? Should I get the PhD, right, that I was telling you about earlier? I don't believe necessarily that an MBA is necessary to succeed in business. In some areas, they really want you to have one. Some companies really want you to have one. Some companies really want you to have a CFA if you're wanting to go into the investment world. I was actually a writer for the CFA, and I didn't even have a CFA. But they kind of let me do it, and they kind of put it on the hush-hush that I didn't have a CFA, right? They made me say I was a CFA level 1 candidate, and I had to buy the books, right? But I discovered that losing 2 more years of my life and getting an MBA and getting out of school with another 50 grand in debt wasn't going to help me that much, okay? I was in a hurry. You remember, this is the guy who quit high school to go work for Bear Stearns, okay? I was in a hurry, and sometimes that's good, sometimes that's bad. But I would say that's, again, a very personal decision in terms of whether you want to do an MBA, whether you want to go to law school, all that stuff. On that topic, I say follow your heart. If you've always wanted to go to Stanford and get an MBA, man, do your best to get into Stanford and get an MBA. And if you've always wanted to go to, University of Chicago Law School, man, try to make it happen. If it doesn't happen, have a plan B. and be willing to understand that wherever you land, you can always land on your feet. If you've got skill, if you've got effort, if you've got motivation, just the motivation part alone. If you're motivated, you're way ahead of most people. So, anybody else? Yes, sir.
How much do you read a day?
How much do I read? It's hard for me to quantify because I read so much stuff that's, just sort of newsy or, stock specific. I print out these big long SEC filings, which I wouldn't, it's not really reading. It's kind of more analysis and that sort of stuff. What I will tell you is that books on tape, I do drive back and forth to work. It's about 10 minutes each way. And then when I drove down here, I always have a book on tape of something that has come out that somebody told me is good. I buy it, and either I buy it in the CD format or I get it on iTunes, listen to it. What's great now that wasn't around when I graduated, but I discovered that I can order German books off iTunes and have it play through my car. And I went through all the Harry Potter books in German, okay? And let me tell you, if you haven't read them, there's a lot of words that don't exist, okay? And there's a lot of very specialized vocabulary that I hadn't heard before. So to listen to, I'll give you an example. When I lived in Germany, there was not a verb to Google somebody, okay? It didn't exist. Well, I recently was listening to a novel in German. Now I know how they say to Google somebody in German. It's become a German word too. Luckily, it's the same word, right? It's ich hab's gegoogelt. That's it, right? But I heard it, I was like, oh, that's how they say it, right? So it actually has, this book on tape thing. I would encourage you guys, if you can read 50 books a year, you are doing really well. But if you can listen to 50 books a year, it's actually just as good. And in some ways, it's better because, you hear, I don't know, there's something about listening to things that's also a good skill. So that's something that I do. I'm a little bit of a book nerd, so not for everybody. So anybody in the back that hasn't got a chance to? Yes, ma'am.
Earlier you were speaking about the concept of margin of safety.
Uh-huh.
And we understand that you implement that into your investments. But have you personally ever been out of that margin of safety because you were confident that this business or investment was going to be a success?
Yeah.
Or is it because you researched that it was going to be a business and success? So is it more of like an intrinsic feeling or an extrinsic?
That's a really good question. What I would say is this. One way to think about that is, I was telling Dave, and I actually have this little essay printed out for you guys if you're interested. I didn't put it out because I'm not sure everybody wants to read it, but I think there's really only 4 decisions that you have control over on the investing side. What stock to buy, how much to pay, how much of your portfolio to put into it, and then once you own it, you have one more decision that's under your control. Should I sell at today's price or should I not? That's it, okay? So part of the margin of safety is, hey, if I'm really confident, then I may make a position size quite big, right? But for me, quite big is probably 7% of the portfolio or 8%, okay? And it's also price dependent. So for example, if I think a stock is worth 20 and it's selling for 15, and I'm really confident that that's true, I may still start off with a 5% position because I've been around. It's not my first rodeo. I've seen stocks go way down. And I will tell you this, I have an incredible talent for buying a stock right before the thing goes down 10 or 15%, okay? I am the man. If you want to make that first 10, 15%, watch what I do, do the opposite, okay? But that's why I go in a little smaller than somebody who may think they've got it right there, because I want to leave myself room just to have another bite at it if I'm really convinced, okay? I will say this, life has taught me that the people who think they have a sure thing and they bet appropriately for that, which is everything you got, tend to not make it out of life with everything they got, okay? And so my view is that I never bet the farm on anything, except I would say this, when you're talking about your career and yourself, in the investment world, you never bet the farm on anything because nobody's that good, okay? And the future is very unpredictable. But when you're betting on yourself, go all in. And that means just giving it everything you got, okay? And believe in yourself. Because let me tell you, you're capable of so much more than you think you're capable of. And that's really true. Yes, sir?
Dave mentioned you did exceptionally well in 08 and 09. What strategy or approach did you have?
Again, it wasn't different than what I would have done, and I have to confess, I didn't really see that coming. I didn't think it was going to be as bad as it was. Fortunately, we were short some of the stuff like Lehman Brothers, Bear Stearns. We were short some of that stuff, which really helped. When you're short something that goes to zero, that makes a lot of money for you, and it gives you money on the long side to deal with it. But really what we did was we had set up our risk management policies beforehand. We talked about what kind of things were in the portfolio, and basically we just stuck to our risk management things, and we got lucky that that approach was robust. The problem is that I don't think most people can see an 08, 09 coming. And if they do, they never really know exactly how it'll play out. And man, that could have gone, in alternative universes, that could have played out in a lot of different ways, okay? But what I will say is that we just have a naturally sort of approach that we say, hey, we could be wrong about this, we could be wrong about that. Let's build a portfolio where, first of all, we're also short some stuff, right? Not short, we have a mutual fund where we're not short. We were down 20%, but the market was down 40 for the S&P and worse for just about everything else, okay? But we made it back very quick. So we were up about 45% in 2009. So in both of our strategies, whether we were shorting or not, the one we were shorting, the hedge fund, we were down 7, okay? Either one, if you'd have just been asleep for that whole time, if you went to sleep in March of 2008 and woke up in September 2009, you wouldn't have known anything had happened, right? But while you were awake, it was much more uncomfortable in the mutual fund because we weren't shorting. And so you went down further and you went up further, okay? But you ended up in the same place. And fortunately, our mutual fund at that time was very small. And I don't know who those people were, but nobody left. Nobody left, okay? Which is incredibly unusual. So we were very blessed in that respect. I did have a fund that Dave did mention that was also, it was an international fund, okay? All European investors. And it was $70 million. And my hedge fund was also $70 million. Every single client in that international fund took their money back between September 2008 and May of 2009. $70 million went to zero, even though I didn't lose any of it. And the reason was that they were losing all their money elsewhere, and mine was the one where they thought they could take it out and have it actually, some actual cash. And so because I did better than everybody else at that period, I became the source of capital for the people who needed it. And so the world is not always fair, let me tell you. So I got really punished, I think, for doing a very good job, okay? But on balance, I think it helped our reputation. So, and I did the right thing. A lot of hedge funds said, no, you can't have your money back until the market comes back, right? And I said, hey, if you need your money back, we promised to give it back when it was available. We had the terms laid out, and we honored those terms. And unfortunately, my business suffered for it. But I think our reputation was enhanced by it. So hope that answers your question a little bit. So, yeah, back for 2? Okay. Thanks, guys. Appreciate it.
So as a value investor, you mentioned Buffett earlier, and you frequently own Berkshire Hathaway. Has the advanced ages of Buffett and Munger, does that cause you to think any differently about the business and your investment in it?
That's difficult to answer, but I will say this. I would be much more enthusiastic about owning Berkshire Hathaway if Warren Buffett was 60 rather than 84, and Charlie Munger was 65 rather than nearly 90, okay? Because then they have many more years ahead of them. I think Berkshire Hathaway will do fine once they're gone, but I think a lot of people like to say it's going to be the same, okay? I just don't see, if you take out 2 of those guys who are some of the best investing thinkers of our generation, okay, if not the best, that it can possibly be quite as good, okay? Because to say otherwise would basically mean that those 2 guys really didn't do a whole lot, right? The truth is that the success of Berkshire Hathaway is less reliant upon Warren Buffett's brilliance than it's ever been, because they just own so many great businesses, right? But I think that to believe that Warren Buffett is the greatest investor of our generation, and to believe that any company he's associated with is not going to be worse off when he's gone, that's a hard thing to say, right? And that's my general belief. And also, companies that lose somebody who's so central to setting the culture of the business and all those things, that'll be a big vacuum to fill, right? I mean, there's nobody qualified to be Warren Buffett too, nobody. And people who and I'm not a hero worshiper by nature. I don't necessarily understand why people hang around at 10 o'clock at night at a Dairy Queen in Omaha on the off chance that Warren Buffett shows up, right? On the other hand, anybody who thinks he is not the best investor of all time through all the things he's been through over a 70-year career just doesn't understand investing very well. And that's just, so yeah, I still own it. I still like it. It's a great collection of businesses. It's not super cheap. It's on the low end of fair value in my opinion, but it's got a lot of business momentum. And Warren Buffett, I think, is still at the top of his game. And I don't know how that's possible at his age, but he's terrific. I mean, he's a very rational thinker. So, yeah, somebody in the back?
What steps do you and your team go through before you write a company off as too tough for you to invest in? Is it because you don't understand it, or is it just it won't play out?
There can be a lot of reasons that it's not that a company's too tough. If you think about it this way, we only own about 25 stocks at any given time. So by definition, we're saying no to some huge, if there's 15,000 publicly traded companies, by definition, we're saying no to 99.999% of them, right? So we have a process where we look for an hour and we say, okay, I still think it looks okay. Then we go for a half a day. And by the half a day period, we kind of know if we're interested or not, okay? If it's price, we'll kind of make a note, put it on an Excel spreadsheet and say, hey, if this price was 50 instead of 70, we'll look further, okay? If we're in there and we're like, okay, I can't figure this out. There was a business that I looked at the other day, and again, I've been reading, I've been studying businesses for 15 years. At the end of the 10K of 150 pages, I still wasn't sure what business they were in, okay? And I'm like, if that's the case, I don't care if it trades for 3 times earnings. I don't get it. So it still does happen to me, but it's for a variety of reasons. I'll say leverage is another one. Domicile, if it's in Russia, or if it has a huge amount of business in Russia, off the table. If it's in Argentina or Venezuela, I'm not looking at it. Most Chinese companies, off the table for me, too hard, okay? I've done some investing in China, and I've learned 2 things. You can't trust anything or anybody. Some of them are great and some of them aren't, right? You don't know what you're looking at. You don't know if you're looking at real numbers or made up numbers. And so, I just kind of, if it even smells of too hard, okay? Now, we'll do a great deal of hard work to get the right answer in a business we do think we can figure out. So it's not laziness. What it is efficiency, right? We want to zero in very quickly on the companies that we think we can get. So, and I think you had a question as well, sir?
Yes, sir. You kind of spoke a little bit about real estate with Donald Trump and stuff, but over the course of that 45-year investing period for the young people, would you advise against property investment, or what is your take on that?
Look, I think rational investing in anything that you're good at is a very, if you're good at real estate investing, then you're good at real estate investing and you should do it, okay? Now, I know some people that are terrific at it. One of the things about real estate investing is you almost have to take on debt or leverage to make real estate investing generate double-digit returns, right? And I have a very strong aversion to taking on debt, okay? I don't like it because if you take on too much, it can come back and really hurt you. So, but I know people who are just amazing real estate investors. They just have a gift for knowing that, hey, if development's reached here, it's going to reach here in another year or 2. Let me get ahead of it, and I'll buy these lots. And some guys are really good at taking a property, and they can see what it could become. And so they'll buy the property for what it is now at full value, but then they'll make modifications to it and turn it into something of greater value, okay? That's a skill that I don't have, but I admire it very much. And the thing about real estate is a huge, massive market. And there's probably many more real estate-related investing jobs or that have some flavor of real estate investment where you need to have those sort of skills than there are stock market investing jobs. So because it's such a big, and also because it's very, I think it's much easier for people to understand, right? You don't have this thing of, hey, what could this business possibly be worth if they grow earnings for 20% per year for the next 20 years, right? Or if they can cure cancer, what's that worth, right? You got a building, and if you fill it up with tenants and they pay you cash, and you can get 9% from the cash at 90% occupancy, well, you run the numbers and say, okay, that's worth X, right? It's like buying a house. You're never going to, except in 2006 or 2007, you're never really going to pay really much more for a house than what other people have paid for their houses, right? So I think that's the good thing about real estate. It's the tangible asset. It doesn't move around every day on people, so it takes away some of the emotional cascade that can come from You know, when it goes up, you feel great, you're the smartest guy on the planet, and when it goes down, you're the biggest idiot, right? Real estate, unless you over leverage or buy at the wrong time at the wrong price, which, you know, like everything else, you got to know what the property's worth, and then some people have skills on top of that to take real estate and transform it into something better. So I think real estate's a great, if you feel the affinity for it and you like tangible assets that you can understand, man, real estate's it's a big industry and it's a good one. So, all right, one more.
Do you recall the worst investment mistake you ever made? And not necessarily because it lost you the most money, but
yeah.
because looking back on it, you think you probably never should have made the investment anyways.
Yeah.
And on the flip side, the best investment you ever made and how you were able to figure out beforehand why it was going to be so good.
Yeah, you know, all the good ones kind of blend in my mind. To me, I get paid to make good decisions, so those don't go up on some sort of trophy wall for me, you know? I mean, that's just sort of how it's supposed to happen. But the bad ones kind of stick out. The worst one I ever made was not a big one in terms of how much performance it caused, but it sticks out to me because it was kind of all the things that I'm not about. And you're going to laugh. This was when Tesla first went public and had like a $2 billion valuation. And by the way, I lost a lot of money shorting Tesla, believe it or not, okay? Tesla, by the way, today is valued as if it's half of BMW, okay? And BMW produces 2.1 million cars a year, and Tesla produces 25,000, okay? So it's a crazy thing. It's like, you know, well, anyway. The mistake was there was a company that was like Tesla called Fisker. And some of you have heard of it. If you haven't, it's because it's already gone, okay? But here was the decision, here was the mistake. And it wasn't a mistake of valuation. It wasn't a mistake of anything. I got called, and the call was this. Hey, we're doing a final round for Fisker before it goes public. Leonardo DiCaprio is in the round. John Chambers is in the round. The guy from Salesforce.com is in the round. And we had one guy fall out, and there's $1 million left. And then they're closing the round. And I thought you might want it. And he shipped me over a prospectus. It was all pictures of the shiny car, and it's mostly cartoons because the car didn't exist yet. And there was projections of what the car was going to be. And I looked at Tesla and I thought, I'm getting basically what looks like Tesla for a third of the price, right? And so I rationalized that I was making a decision, but really what it was I've never been a person who wants to be part of the club. I don't know if I'd walk across the street necessarily to meet John Chambers, okay? But something about that appealed to my ego. It was like, wow, I'm finally getting the call that all these guys get. I am now somebody. And if I don't play, I'm not going to be in the club, right? These are thoughts that have never occurred to me before in my life. And I think, and it's not like I was thinking that, but I think somewhere deep in my head, it was an ego-driven decision. And I said, yeah, I'll put $1 million in it. Which, I mean, it sounds like a huge amount of money, but I was running 130, so it was not a big piece of my fund, right? And if it all went to zero, which it did, okay? By the way, it went to zero so fast because they knew that they were out of money, and they knew that they were about to get recalled, and they knew that they were about to lose their DOE loan, and they got out of raise real quick, okay? So they basically lied to us all, okay? And I had the chance to sue them, and I chose not to because I felt like the cost of suing would probably, A, I didn't see how they had any assets to go after anyway, and B, I just was like, hey, I didn't lose my money because Fisker lied to me. I lost my money because I was an idiot, okay? And so I kind of I like to take responsibility for the decisions I make. Now, maybe I should have sued him for lying, but at the end of the day, the reason that sticks out to me is I've lost lots more money on other things, but it was how I lost it. I lost it because I was somebody who I normally am not, right? I let some other emotion, some other factors somehow subconsciously enter into that decision when I should have been focused on value, and I should have been trying to protect my clients from. By the way, the other thing I'll tell you is if an investment idea is really good, nobody's going to call you on the phone and say, hey, I got a great investment for you, right? They would have already made that investment. If they're calling you on the phone, it's a sales job, okay? And that's not how great investments are found. Great investments are found when they can't dump it fast enough in the stock market because they're afraid, and nobody calls you and says, hey, this is the best thing ever, right? So. And by the way, those of you who are ready to leave, feel free to, I'll stay as long as anybody wants to ask questions, but I know it's Friday afternoon, and you guys have been amazing. I can't believe you're here this long. I think I would have left 20 minutes ago, except I've got to be here. So,
Charlie?
Yes, ma'am.
Robert?
Oh, sorry. Can I get your question, ma'am?
So being a student about to graduate and looking for jobs in January,
Yeah.
and seeing that the salaries are like $30,000 for education,
Okay.
how do you know when you have enough to start investing?
Well, I think probably your first and second paychecks generally go to getting a work wardrobe, getting living arrangements, getting a few necessary things to transition from a college student to, kind of a workplace. But my answer to you is your second or third paycheck. And it has nothing to do with how much you make. And that's the sad thing is, what you have to do is use your imagination and your skills to find a living arrangement where you can spend less than you make, okay? And I know on $30,000 that doesn't sound like it can be very much, but I've met people who make very little money and somehow they've managed to save a lot, okay? And so the less you make, the more creative you have to be. So I would suggest that you try to do things like find someone to room with. Even better, if you can buy a condo and bring in a roommate and let them pay part of the rent while you're getting equity on your condo, man, that's a great way to build wealth, particularly in a smaller town, not in a big city where the condos cost a lot, but where condos don't cost that much, relatively speaking. You can get somebody to handle 60% of your note, and you're building equity every month, right? I would say that maybe you need to drive a 3-4-year-old car, but you have to make some sacrifices early on. And I'll tell you this: I mean, it's really easy for me to get up here and say, hey, when I got out of school, I had $40,000 in student loans. Now I got $40,000 my first year, which was New York money, because I moved to New York, and I realized that was like 10 grand in Dallas money, right? I mean, you could not buy anything in New York for that. So I bought no TV. I just had the basics, and I would say this: before you start investing, if you have any debt that is credit card debt or student loan debt. Oh, here's one other thing. What they don't tell you about the student loans enough is that student loans in this country is the only debt you have that is not cleared in bankruptcy. You go out and blow 50 grand on a car that you can't afford, and you make the first payment, well, you declare bankruptcy or they come get your car, right? And it's over. And they're not going to let you buy a $50,000 car again for a couple of years, I'm sorry to say. But it's not that terrible decision that you can't recover from. Student loan debt is and I think this is terrible and paradoxical, but that's the one debt that they won't let you clear in bankruptcy, right? So pay that down first, okay? If you have credit card debt, anything that's high interest, look, I'm telling you about the compounding power of making 10 or 12%. If you're paying 18% on credit cards, you're going the wrong way, right? So try to get your net worth to zero, okay? That's what I had to do when I got out of college. I was like, my net worth's minus 50,000 on day one, right? Let me get to zero, okay? So if you don't have debt, go ahead and start investing with your first couple paychecks. If you do have debt, pretend that's your investing strategy. Pay down much more than the minimum credit card every month. Try to pay down that student loan, and if you come into a little bit of extra money, literally write a big check and see if you can pay down something faster. And then once you're to the point, and I mean, saving and investing is a habit, is much more than anything else. So once you're ready, set up something automatic so that when you get your check, you don't even see it. It's gone. And if you don't see it, you really don't know it's there because they take out so much other stuff for taxes anyway. That's what I would do. That's the sort of discipline light approach to doing it. But I'm sorry to say that look, it's your first couple years out of college. There's so many pressures on you to spend money on this and that. You want to look nice for your job. You're out on the dating scene. You want to look nice for that. You want to have a decent car. You want to have kind of a cool apartment so you're not embarrassed to bring your friends over. Every once in a while you still have an epic party to go to because you're not quite old enough or you don't have those anymore. So, I mean, there's just all these things. Look, it's true. I mean, I know. I've been there. I've even had an epic party. But you gotta try to live life while at the same time being disciplined, or else you're not going to get there with the $5 million. So, sir.
You just spoke earlier that you don't do anything in something you don't understand.
Try not to, yeah.
The social media companies are phenomenal. And I ask participate in those?
I don't participate in them in investments, and because of my paranoia, I'm not on Facebook. This is totally off the subject, but my view, and this is something I didn't understand when I was 25, but civil liberty is what sets the United States apart from virtually every other country, and that is you have a right to privacy. You have a right to carry cash and have transactions that are not recorded and monitored by the government, okay? My view is, and also as an investment advisor, there's all these SEC regulations that says, you know, if I accidentally talk about my business on my Facebook page, that could be considered an advertisement, which I'm limited to doing. So I'm not, you know, as a registered investment advisor, I kind of stay out of any gray areas. But I would say that I don't understand it all entirely. I think some of the new technologies are awesome. But what I do find is this, and this is just a general observation from people younger than me, is that there's a life that they have on Facebook, and then there's a real life that they have. And sometimes those two are very different, right? And also, a lot of younger people make terrible mistakes on Facebook. They'll put something out there and think it's just there. You know, they'll have pictures of them at a party, and then all of a sudden, I'll tell you this, it is absolutely part of the process for an employer now to do a search on the internet and see if they can find you with a picture, you know, urinating on a statue somewhere, right? Or doing the crazy things that all of us did, right, when we were college students, because that's when you're allowed to do them. Well, if you've got pictures of it, and then 2 years later you're like, hey, I need a job, right? Well, back in my day, you could dress up in the suit and tie, and people were like, wow, what a responsible looking guy. Well, today you show up in the suit and tie, and they may have a picture of you doing something really stupid that you gave them on Facebook, right? So I would encourage you, and the same thing is true of email as well. I mean, you know, the communications change quite a bit, and you'll email things to people that you might not say to their face, right? Because you have this separation illusion, right? But the written word is just as powerful, but not more so, and it's all permanent. Let me tell you, if you think you can pull that stuff down and it's not cached somewhere or Google can't get it, and let me tell you, that stuff, I mean, I don't think it's in the private realm. And so I'm very careful about it. Again, I'm kind of old and cranky, but you know, I'm used to a more simple world, and you may be as well, right? When there wasn't 24-hour surveillance of everything. So in general, I like the fact that a lot of the crime goes away because there's cameras everywhere now, and so I'm appreciative of the safety. But safety and civil liberty is kind of, you know, there's kind of a trade-off there, right? Sometimes you get the illusion of safety, but you have to give up a lot of liberty. And the older I get, the more I realize, and the fact that I've lived other places in the world, man, the United States is special, but it's only special as long as we preserve what it is, which is civil liberty being a key. So sorry for the soapbox there, but that's an interesting topic. Yes, sir?
You said earlier that you like to do a lot of quantitative screening from time to time. What are some of those metrics that you like to look for? How often do you do it? And when you're not doing quantitative screens, where are your favorite places to look for ideas?
Yeah, you know, we'll run screens on saying, hey, show me all the stocks under 500 million market cap that trade for less than 5 times free cash flow or 8 times free cash flow. Show me all the ones that, you know, return on investment capital is going up every year for the last 5 years. We'll just play with it. Quite often it's just to kind of give us a sense of where the world is, like how much stuff looks cheap statistically and how much stuff looks expensive statistically. There's a lot of financial illusions when you run screens. A lot of stuff may screen well, but when you get in there, it's a terrible business, or you know, the numbers just aren't real because there's something that's fabricated in them, or you know, the business has done great for 6 months, but it's a very cyclical business, and you know, they got a big order or something. But we do look, and sometimes we find something. But our best source of ideas, believe it or not, is a company that we've analyzed in the past, and that we either sold or passed on, you know, because it got fully valued, and then it comes back. And now we can look at it again. And so the longer we've been doing this, the more we realize that, hey, we owned, you know, here's a company we looked at in 2003, right? And now all of a sudden, for some reason, it's interesting to us again. And we go back and read the notes we had on it from 2003, and then we try to pick up what's happened in the interim, right? And sometimes the market gets really volatile that we can buy a stock at well below fair value, sell it at fair value, and then it's back to below fair value again 6 months later, and we'll buy it again and, you know, kind of do the same thing. We don't like to do too much of the trading thing because it just sort of makes us feel bad, but sometimes it's the right thing to do. if it's rational. So, yes, sir.
Tesla, when you lost money on Tesla, was it because you tried to look at it as another automobile company, compared on the same criteria, and maybe didn't understand who the buyers were going to be and what the emotion would be about buying an electric car? Does that fit?
You know, there's a lot of possible reasons why we were wrong about it. I will say this. I'm not going to say I was wrong permanently, because I've been around a long enough time to see these things. With the fullness of time, a lot of things end up coming around, right? Yes, there's an argument out there that Tesla's not really a car company, but it's a technology company with batteries and all this stuff. Well, I'll say this. Right now, they're expressing themselves in the form of making cars. And making cars is a pretty tough business to make money in, okay? And no company that's ever looked like Tesla has ever been valued like that. And the people that own Tesla stock are not people that own that have looked at other car companies, right? So it's its own thing. I would say this. I think that it was a heavily shorted stock already. You have a very charismatic founder who's very smart. They got a real benefit, a one-time benefit from a huge number of government credits that made them look extraordinarily profitable. But then there's also something that I'll call, George Soros calls it reflexivity, and that is when the market creates its own reality. And here's what I mean. So Tesla was almost bankrupt a couple years ago, right? They managed to raise enough money to get through. So they're about to launch the cars. The year they launch happens to be the year that they're able to sell a bunch of credits to other car makers for $15,000 a car, okay? So they're not making any money on the car, they're making money on the credits. And then they're heavily shorted, the numbers come out slightly better, everybody covers, the stock goes from 60 to 75, they sell a bunch of stock at 75. So now they pay off their DOE loan, so now they're financially stable, which makes them more valuable. So the stock goes to 100, right? Then they announce another a lease program, which they weren't qualified for before. And everybody runs the numbers. And by the way, the Wall Street guys on the sell side keep raising the price targets, right? So it turns into this kind of mushroom cloud of hype and I would say self-reinforcing belief, okay? Now, I don't believe Tesla's worth anywhere near what it's trading for. That's my personal. But my mistake, and it was a mistake for me to short Tesla, was more of a game theory mistake, if that word means anything to you, right? I was so focused on what the business was worth, which I thought was a fraction of what it was trading for, that I failed to take into account all these other softer things that should have gone into my calculus. The high short interest, the promotional management, the sell side support, because they were going to run that stock price target up because they knew Tesla needs to raise several $billion just to get to their next car, right? And so it was a sort of a chain link of events that were all reinforcing, and I did not see that coming, and that was my mistake.
Could you say to some extent that they were elevated somewhat by their own fluff until the materiality of some of those events came to support them?
I think it's been a
yeah. Stock price.
Well, I'll say this. I think the business has turned out better than I would have expected. Certainly they are a very exciting, I mean, I've never argued that they're not an exciting company with exciting technology and that they will end up with, you know, a nice business, you know. I just think that the mushroom cloud of hype was just really overdone, okay? But yes, I mean, all I can tell you is that there's been, in my experience, I've never seen a period for any company where so many things could have gone wrong or gone the other way that didn't, okay? Whereas with Fisker, which was a very similar story, everything that could have gone right went wrong, okay? Literally, right up until the day where they were going to deliver their cars, and they delivered them to the port of New York City just before Hurricane Sandy came and wiped out 330 cars, and then the insurance company wouldn't pay the thing because they said it was in transit, right? So like that, if that happens to Tesla, Tesla's a zero, okay? But it happened to Fisker instead, so Fisker was a zero. But I will say this, you know, right now, my view is it was a mistake for me to short Tesla because of a lot of things. I'm just not sure which of those things was the mistake, but as a group of facts, I misanalyzed the facts on what it could have meant.
Given the realities that you determined at this point, what does this do for your analysis when you go forward? I mean, I've had a lot of bloody toes and fingers, and trying to figure out how smart people, I started to say other smart people, but smart people make tragic mistakes is really interesting. And the Howard Marks they had a piece on here.
Yeah.
And I read it and I think about it and I read it and I think about it and I say, okay,
Yeah.
the guy's obviously very bright. Tesla's obviously gone crazy. I looked at it and said, there's so much fluff here, I don't know how to cope.
Yeah. But you did the right thing.
So the thing always affects me long run.
Yeah. You did the right thing and didn't play it, whereas I tried to be smarter than the market. And on the short, I'll say this too. I mean, we sized it appropriately, and we kicked it. I kind of came to the conclusion that it wasn't worth the pain. Even if I end up being right, it's not worth the journey. So I don't have a position in it now, and I probably won't short it again. I'm still convinced in my mind, of course, that ultimately the market will value the business appropriately. But it's just got kind of crazy, and the stock market can be a combination. We like to think of the stock market as people competing to value businesses, but another thing that happened is Tesla got put into an index, and all of a sudden, all the mindless people who don't even know what they own, who run the indexes, say, "Oh, we got to buy some Tesla because it's in the index, and we represent the index, right?" And so all of a sudden, you had this new buying power come in. And based on the analysis that we had done, Tesla was nowhere close to qualifying for the index. But because it went up in price so much, and the index is based on market cap, right? So it was really a unique, I would say, perfect storm of good things for Tesla, bad things for those of us who are shorting Tesla.
Didn't fit any of your spreadsheets. Material.
Well, and look, I'm not such a dogmatic person that I think spreadsheets are the only thing that matter, because it doesn't. Like, there's all these qualitative and quantitative things, and there is a game theory aspect to investing that I have to respect, because if I don't, it'll kill me, right? Particularly on the short side. That one was just hard, and I took a shot, and I was wrong.
Thank you so much.
Yeah, sure. And it cost our fund about 1.3% for the year, which was very painful.
Zeke, you work in a tough industry that does not exactly have the greatest reputation. Can you tell me some of the hurdles associated with ethics and where ethics fit into running your business?
Okay. Are you talking about the hedge fund industry or the mutual fund industry?
Yes.
Okay. Yeah. What's interesting is I've been in the industry long enough now that I've met many people in it. And I have to say that I'm pleasantly surprised by the caliber of people that are there. Obviously, it's an industry that can be very high paying, and so it's going to attract some incredible intellectual horsepower, right? As you'd expect. Just like Hollywood acting attracts, because if you're the best in the world, you make $20 million, per film. Well, if you're the best hedge fund manager in the world, you probably make $40 billion, right? Or $2 billion a year, or however that goes. I'm kind of a small character actor, if you want to extend that analogy, right? I've had some success, but I'm never going to be the Tom Cruise of the business. I will say that there are, in any group, in any industry, there are some people who do bad things. I will say that anybody who runs a registered investment advisor, if the SEC comes to your office tomorrow, they will find 18 things that you're doing wrong, okay? Most of which are paperwork type things or regulations that you're not taking seriously that don't help your clients one little bit, right? There's a lot of gray area, especially in the insider trading arena. What we used to think was clear cut is no longer. What I will say is that on the short side, I think that it's very easy for people to cross the line from being short a company because they believe it's overvalued or believe it a fraud to going public and trying to make that happen. Right? And that's a fairly new thing. It's this new confrontational short selling. And you have to be, I think you have a moral obligation to really know you're right before you go out there and do that, okay? And sometimes they are. And many frauds have been brought down, Enron, for example, by one particular short seller, helped by some less vocal ones. I would say too that, I know many of the hedge fund professionals I know are people that are incredibly generous with their giving and with their time. I mean, just an example, yourself, you come here once a week. I mean, I'm too selfish to do that. I go to Austin College maybe once a semester, right? I'm too, too selfish with what I want to spend my time on. But, look, there's been ethical lapses in our industry and in every industry that I'm aware of. And that's because, and I'll say this, when everything's going really well, that's when the ethical lapses seem to get magnified, right? When the stock market's up, you're going to see more promotions and you're going to see more fraud because that's the time to do it. So it's a hard question for me to answer, but I personally haven't witnessed a lot of it. But I'm in South Lake, Texas. I'm not in New York. I don't know a lot of these people, very well, and I'm sure a lot of things go wrong. And I'm sure that there are people that act very unethically that I'm not aware of. I'm one of these people that always assumes that most people are honorable, and unfortunately, I'm too idealistic sometimes, and I get negatively surprised. But I would say in general, the caliber of people that I've met in the industry is extraordinarily high, and most of them are very honest and ethical people and very generous. So, yes, sir.
Can you talk about the difference in managing captive money versus less captive money, maybe mutual funds versus hedge funds?
Well, in my case, there's really no big difference. One has daily liquidity. In other words, people can take their money out every day, or they could put it in every day. And the other one is, in my case, quarterly. So it's not a huge difference. It's not like I have money wrapped up for 20 years, right? I will say this. There's a huge advantage for people that have a capital base that they know is stable. In other words, I would much prefer if somebody gave me $50 million and said, this is yours to manage for the next 20 years. Nobody's going to take anything away from you, right? I'd much rather have that than somebody say, here's $500 million, but you've got quarterly liquidity or daily liquidity, right? For me, the trade-off is worth it because I don't have to think about how much capital I might have if an idea takes 3 years to play out, right? What I will say is that for a value investor, there's a huge amount of career risk, and you're going to get fired very, very reliably at two parts of the cycle. At the very bottom, you're going to get fired, even if you do a great job, because people are going to be scared and take the money out at the bottom of the market. That's just, they can't help themselves, right? And then you're going to get fired at the top of the market because if you're a real value investor, at some point you get priced out, okay? And you say, hey, I can't buy stocks at these prices because it doesn't make sense. I'm going to sell anything that I just, that I think is fairly valued or slightly more than that. And I may be sitting in cash, for 2-3 years if I have to, and the market may keep going up and up and up, right? So a lot of value investors lost all their clients in 1996 and 1997 and 1998, and they'll do it again, and they have been the last couple of years. I certainly have. So you have to decide what you're going to do. Are you going to do what you think is right and take care of the capital that you have, and let the money come and go as it sees fit, or are you going to try to play the benchmark game and keep up? And it's a tough call, but that's just the nature of managing other people's money. It's very hard for people to hang in there, and I would say our industry is becoming extremely focused on benchmarks, right? The S&P, if you can't beat the S&P, something wrong with you, and that's a tough thing. So, yes?
What are your thoughts on the Burger King merger?
I don't have deep thoughts on it. I do know that there's this, there's a greater topic there, which is the whole tax inversion thing, and that is that if you run a business in the U.S., theoretically your tax rate's 35%, whereas if you move your business to Ireland, you pay 10. If you move your business to Canada, it's probably 20. And if you're a rational business person and you have the opportunity to move a business at least from a tax domicile to where you're paying 10 from where you're paying 35, well, I mean, you have a duty to your shareholders to do that, right? I believe that the U.S. would be better to lower their tax rates at the corporate level and to close off all the loopholes so that everybody really does pay 15%. I mean, right now, I can tell you for a fact that there are big U.S. companies that make all their money in the U.S. that don't pay very much U.S. taxes because they have these things. And I just think there needs to be tax reform at some point, and there never will be. And that's just, but until we do something about it, and by the way, it's exactly the wrong thing for President Obama to go out and say, you bad people, why are you, it's unpatriotic to leave the U.S. where we force you to pay 35% taxes and move your business to Canada, which is incredibly easy for you to do, and pay 10, right? Because what's it going to do? It's going to go, oh, Obama's going to take away our taxes. We better do it right now, right? Just like the gun thing. I'm sure you're aware of this huge bubble in gun sales the last couple of years because Obama made many Americans think that they weren't going to be able to buy guns anymore. So what do? They all went and bought 3, right? It's the wrong, it's the wrong policy response because it creates the wrong incentives, right? And so this is another one of those political things that I think the gut reaction is, wow, it's unpatriotic to move those businesses someplace else. But if you think about it for just 1 second, and you put yourself in the shoes of those managers, you realize it's their duty to make smart financial decisions, and we need to adapt our policies here in the States. So, yeah.
You mentioned that you sell at fair value, but I mean, one of the discussions that we were having last week was like Buffett's moved on to businesses that he owns and hold, he wants to hold forever,
right.
And he's kind of adapted that to even just like partial ownership of the stock, that he would wait for it to be extremely, extremely overvalued.
Yeah.
Is that something given before that you need to generate the return, that I mean, once it becomes fair value, you can go find something else with it? Or I mean, do you give any more consideration to waiting until it's like significantly overvalued to get out of the position?
Well, Warren Buffett, when he was younger, he would buy at discounts and sell at fair value, right? Now that he's managing so much money, he's often on the boards of these companies, it's a really hard thing to sell 12% of Coca-Cola and not make a dent in the price. Now, he said that it was a mistake for him to hold on to Coca-Cola when it was trading at 70 times earnings in 1999, right? So I think a lot of what Berkshire does and what Warren Buffett does now is just totally dictated by the size of Berkshire Hathaway. I mean, you have to think how much capital he's got to work with. I mean, whereas I can sell most of our positions in a day or two without moving the price, and it behooves us to sell. I believe you buy stocks at discount to fair value, and somewhere within the range of fair value, we like to sell some. If it's a great business with good momentum, I should probably hold on longer, and we're trying to learn to do that. What we've discovered is every time we make an exception, we get whacked. So, different. I think it's a style difference, but I think the size of the capital base makes a massive, massive difference. Also, he's got to. I mean, for him to buy anything that moves the needle, he's got to put to work $1 billion, right? Whereas 1% of my fund is $660,000. That's all I got to find enough to buy. So I can buy much smaller businesses, which dramatically increases the number of stocks I can consider for purchase. So yes.
When do you know to sell?
When I know to sell. Yeah, you'll have this slide which gives you some indications. The truth is you never know exactly when to sell. There are a few times when you're like, okay, this is the moment. And for me, it's usually when, for that moment, the eyes of the world are on your stock, and it's like the sun's shining on this stock today, right? And, you're seeing people put up, you're seeing stuff in the public domain about your stock being worth way more than it's likely worth, right? So we try to do the best we can. But in general, selling at fair value is usually not the hard thing, even though it's hard to know whether you should sell all or some. The hard part on selling, in my view, is, hey, how do I know am I wrong or am I just early, right? Like if you buy something and then immediately afterwards something bad happens, should you buy more? Should you just hold on to it? Should you say you're wrong? Those are the ones that selling when it works out is usually pretty formulaic. Selling when it hasn't worked out yet or when it's working against you, those are the decisions I struggle with, and I'd like to offer you advice, but every case is very different. So, yes, sir.
How important is philanthropy or giving back in your overall life philosophy?
Well, that's kind of a loaded question, isn't it? Because if I say it's not important at all, then I've kind of come across as a really creepy person. I've got a good friend in the business who was on 13 boards of nonprofits 2 years ago, and his business really suffered for it. Okay, and it caused him a lot of stress, and he was no longer in a position financially to give what he'd been accustomed to giving to all these different things, right? But he's got the gene for it. He really, really does, and he loves to do it, and it's part of his passion. There are a few things that I'm fairly passionate about, and I try to do what I can for those things. But I'm not as good a person as he is. It's one of the things I really admire about him. I try to look for non-financial ways to give if I don't feel like I can give financially. But I also think there is something to be said, and I'm going to use this in self-defense, is that I think it's natural for the first 20, 25 years of your career to be focused on achievement and achieving, I've given you this whole thing about what you need to have to make sure you can survive, right? And then there's a number that once you reach beyond that, I think that's when you start giving back, right? Once you've gotten beyond what you know that you'll need, and I'm not talking about buying the 6th car or the 3rd vacation house, right? I'm talking about a reasonable number, and beyond that, I believe you can be somewhat sacrificial, right? A little bit. But I think it's natural for people to have a phase of their life where they're focused on achievement, and then at some point it changes, and now you're focused on meaning, right? Whatever that is to you. And I'm kind of in that transition period where I've so focused on achievement that there wasn't a lot of room for meaning. And now I'm trying to find the meaning a little bit, or at least spend more time there. And I think that will naturally lend itself. And also at some point I'll have more time. And I find that, it's really easy for me to write a check and say I've done my thing. And I think that's kind of an easy way out too, right? So the answer to your question is I don't really know. For me, it's something I think about. But also, look, from the hedge fund business for sure is a series of 1-year sprints. And I could make a lot of money this year, or I could make none, right, in the hedge fund. So, to a certain extent, I have to sort of live with that level of uncertainty in my own income and that sort of stuff. But I think that's a very, everybody, again, it's a very personal thing, but I'm glad you asked the question, because I will say one of the things I like about value investing is, Warren Buffett's at the end of his life, and for so much of his career, he was the most miserly guy when it came to giving money to his family, to his kids, to charity. He didn't give anything away. Why? Because he said to himself, I can compound it at 20%, and when I'm 90 and dead, I will give the world a huge gift, right? The problem is there are needs then. There are needs, every one of those 50 years that he didn't give somebody money, there were needs that happened right there in the moment, not 50 years later, right? So I think there's, but I think he set a very good precedent with his, hey, I'm going to give my kids enough that, they don't have to worry about too much money, but he started this pledge where the billionaires of the world really show that they're going to give a lot of that money back to society. Now, whether it gets used well or not, that's another question, right? Because it's very hard to measure return on philanthropy, right? So, but a great question. I think Warren Buffett is really trying once again to set the standard of, hey, you invest, you make money, but at some point you give a lot of it back to the system that allowed you to accumulate that kind of wealth. So, yes?
What was the motivation behind you opening up your own shop, and where were you at in your life in terms of what you were doing and what was going on? What was the decision process?
Well, I was really not qualified to work for anybody else. It was it was a combination of arrogance and timing, right? I had been saving since really my first paycheck out of college after I paid off my debt. I had some money, I could take the risk. I was 30, I wasn't married, obviously didn't have kids. I was moving home to Dallas where the cost of living is very low, and I said to myself, look, by the time he was 31, Warren Buffett was Warren Buffett already, right? I'm 30, and I'm in a career change, and it's time for me to get with it. So I guess my thought was this: I'm going to let it go for 2 years, and if it doesn't work, I'll go get a job. It was one of those times, and the great thing about being young, and in my case unattached, was if ever a time to take a risk, it was not going to, if it failed miserably, it was not going to be a terrible mistake, right? I was going to be back in the same position I was in. All right, I'll go get a job. But at least when I went to get the job, I was like, yeah, I ran my own hedge fund for 2 years, right? Doesn't that differentiate me from the guy who just wants a paycheck and, didn't, right? I probably know more about the business side. I know more about the struggles of trying to get clients. I know, I've run everything in the business. I've been the chief compliance officer, the chief marketing officer, whatever. So, no, the time to take risks is when you're young, and I know I've given you all this scare tactic about save, 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 but look, if you've got to burn a little cash to invest in yourself, right? And I was willing to burn about 50 grand if I had to see if that business would work, and I ended up paying about 50 grand to be in the business for 2 years, but then it took off, and I have to say I'm a lottery ticket winner. Most people who would start a hedge fund with no track record no previous asset management experience, right? Didn't know anybody wealthy. I mean, I don't know what the chances are, but it's probably no better than any normal small business, which is 80% failure rate in the first couple of years. So, but I got very fortunate. So, yes, sir.
Can you talk about raising capital and just that whole process?
Yeah. Well, the hardest thing to do in money management is raising money, except for one thing, and that's keeping it. Look, it is extraordinarily hard to find people. And I will say in this culture, even though most people don't think of the decision this way, it's probably the highest honor you can ask somebody is to give you a piece of their hard-earned life savings to manage and protect. I've always tried to extend to people that, look, I don't think of myself just as your money manager. I think of myself as a steward, which is, I think, kind of a slightly higher calling, which means, you know, I really do try to put the client's interest in front of my interests. I try to be as run an ethical shop as I can. I really will invest the way we say we will invest, you know. But it's a hard thing. It's a hard thing to do. I was lucky also when I started. It was late 2001, early 2002, and a lot of people had just gotten totally blown up by the tech crash, you know. And whoever it was, their financial advisor, whatever. You know, they were all 60% in tech stocks if they didn't rebalance at some point, because that's where all the money was going. There were a lot of unhappy people, and I offered them something different. And I was also a little bit arrogant in the sense that if you got me in front of somebody, you know, for 30 minutes, I usually was able to walk away with, you know, a check. At the time, it was a $10,000 or $15,000 or $20,000 check for a fund, which is not very much money. But the process gets harder and more complex as you're talking bigger money, more sophisticated investors. But you know, it was a lot of selling, and that part is very hard. And I don't like to be a salesperson. You know, I prefer not to, but I tried to make sure that my salesmanship was not aggressive. I never tried to promise anything that I didn't think I could deliver, all that stuff. And ultimately, it's a trust game. And you'll find people, if you lay out how you think money should be managed and how you're going to manage it, you want to find clients who want their money managed that way, as opposed to clients who want to beat the S&P every year, or clients that want this level of volatility or that Sharpe ratio, right? Here's our philosophy. Here's what we try to execute. We're not always going to be perfect. If that's how you want your money managed, please come to us, right? And that's all you can do. And then you hope it works. And you know, every money manager who's been in the business has been in a period where they raised money, and then they've been in a period where they've lost half their assets. That's just the way the business is. So.
Can we take one last question?
Yes.
Can you go through a day in your life?
I'm sorry? Can I go through a day in my life? That's the most boring thing ever, right? You know, I mean, I have a very boring life, I guess, to an outsider. I mean, because the investing's all inside your head, right? All the action takes place in your, you know. So, I mean, the getting up and the walking the dogs and driving to the office, and to me, that's all just a blur, right? Because when I'm walking the dogs, I'm thinking about the next decision I'm going to make, right? Now, on a good day, I'm actually walking the dogs and thinking about the stupid dogs and what they're doing, right? And enjoying that, right? But most of the time, my head's somewhere else, because that's where the game is played. It's played mentally. But, you know, I'll say this. It's all research. And, you know, I spend a lot of my time either reading or writing. And I try to write as much as I can, because that's where I put down what I've understood. And if I've written something down about a company and I pull it up and I read it, and it doesn't sound very clear, it doesn't sound very concise, I know I'm not there, you know. But it is the game of making decisions. And so, you know, there's not a whole lot of action. It's all decisions. But it's really important to try to create an atmosphere where you do very good thinking and you have the ability to kind of get in that zone of concentration where you can focus on a problem for a long period of time. So I think I'm going to end there. Man, I can't believe you guys are still here. I would have been out a long time ago. Thanks.
Thank you very, very much. In honor of your trip down to Clean Seguin and to share with us here today, top performing students in Bulldog Investment Company next semester are going to earn the Zeke Ashton Scholarship.
Oh my gosh.
And because we know you need just one more t-shirt, here is very limited, highly collectible Bulldog Investment Company shirt. emblazoned with price is what you pay, value is what you get.
Awesome.
Thank you very much.
Thank you very much.
For more information, please visit tlu.edu.